What do you make of it all? We can start with the PCAOB if you want, saying it secured that complete access to inspect the books, and then move on from there to COVID.
Yeah, certainly the PCAOB decision, some great work from the 30-plus inspectors who spent 9 weeks in Hong Kong, really there to protect the interest of U.S. and global investors. And, ultimately they got a clean bill of health. So we're going to see almost 200 U.S.-Chinese ADRs come off the holding foreign companies accountable list. That really removes the delisting risk, which should bring many institutional investors, many professional investors back into the stocks in the days and weeks and months to come.
Yeah. Is that delisting risk removed for quite some time, or is this something that we're going to be revisiting with some frequency?
Well, it certainly resets the 3-year clock at the same time as both the SEC and PCAOB noted is that this is an ongoing effort. So certainly the companies and their auditors will continuously have to meet the standards outlined by Congress. And I think ultimately it really behooves not only the Chinese companies, their auditors, but certainly the Chinese government to allow these companies to stay listed.
Yeah. All right, let's move on to the other side. Both lifting of restrictions on COVID, the number of cases, and what seems to be at least, a sense that the Chinese government is also trying to sort of ease some restrictions on technology companies. Do you really believe it? Do you see it? And what does it all mean, if so?
Well, 100%, David. Post-party Congress, we're seeing a significant policy pivot to address 3 very significant issues that have weighed on China's economy, but certainly also China consumer sentiment, as well as investors' sentiment toward China. That's U.S.-China political relation, the zero COVID policy, as well as the real estate sector. And you're seeing a major change on all 3 of those issues. And we think that's going to allow a re-rating, that investors can come back into these stocks. And we certainly want to emphasize that domestic consumption is where Chinese policy is headed. And certainly for us as investors in Chinese internet companies, those e-commerce companies are the transmission engines for domestic consumption that we hold in KWEB. So we're very constructed for 2023.
But how much of a surge in pent-up demand do we actually expect in China, Brendan? Can we use the U.S. as a playbook? It really hasn't been the same at all. And if they really do open up here, some of these models, the RAND models, estimate 100 million symptomatic cases of COVID, 500 million hospital admissions. The numbers are staggering, and up to 1.6 million deaths.
Yeah, certainly one of the key issues is that Omicron has a lower lethality rate than Delta and other variants, which is part of why you're seeing this change in policy. At the same time, you're going to see a major push to vaccinate China's elderly population, which has been very slow to adopt these various medicines. And I think, to your point, Sarah, McKinsey recently released a great report on the Chinese consumer, which said that almost $2 trillion of excess savings have been built up in China due to COVID restrictions, real estate issues. And I think that's something that you're going to see that money come out of savings, go into the consumption. That's a great thing for the internet companies in KWEB. It's certainly great for many U.S. multinationals operating in China today.
Brendan, thanks for the update. Appreciate it.
Thank you. Happy holidays.
And to you, Brendan Ahern.